Hi everyone, it's Mike from Order Flows and welcome to the Order Flow Dynamics course, module number 4, trading the vertical versus horizontal. Now, many traders don't really think in the vertical and the horizontal, and we look at horizontal levels mostly, right? We look at the volume profile, we look at market profile, we look at pivots, we look at trend lines, etc. And vertical levels are created in the moves up and down. So let me explain. So here you have a volume profile on the left of the chart, right? You have a nice distribution, normal distribution day. This is a nice horizontal day, right? We sort of just rotate around. Vertical days are days that trend, right? That market keeps making new higher highs or lower lows. Now, horizontal versus vertical market activity is not how many traders view the market or approach the market, right? They simply think the markets go up, markets go down, or markets go sideways. However, you can split that market activity into two different views: horizontal activity or vertical activity. So when a market tries to make a vertical move and fails, fading that vertical move is an easy trade to make because more often than not, the move reverses or it goes sideways. This is information generated from the market, but you don't have to rely on the market profile or volume profile. You can see it in the order flow. So vertical moves are often to new highs or new lows, and what you want to look for is POCs. Are they migrating higher or are they migrating lower? Strong delta, in the sense, is delta on a bar by bar basis expanding? Is cumulative delta expanding, getting bigger or getting weaker in the sense of more negative? Are there imbalances present? So here you can see a vertical move on the way up as you're making new highs. What do you see? Right, you see delta getting stronger, cumulative delta. It went from minus 2,700 here to these new highs. You're putting in minus 1,580. It's still negative, but it's gained 1,000 in the delta. Points of controls also moving higher. You're seeing a lot of buying imbalances. These are all signs of a market starting to move vertically. Here we're at the high of the day and the market starts going down, right? You're seeing the vertical move down this time, right? Think of vertical, don't think just one direction up. It can also be a vertical move down. So we're at our high of the day. We're starting to see lower points of control. We're starting to see imbalances. We're starting to see negative deltas, right? The market starts going down 1, 2, 3, 4 bars, and it goes sideways for a while. Okay, it's unfortunate, but unfortunately that's what the markets do sometimes. They go sideways. Then the vertical move down continues here. 1, 2, 3, 4, 5 bars, all 6 bars, all lower points of control. You're seeing selling imbalances. You're seeing strong negative deltas. And again, if you're looking at cumulative delta at the high, we're at 1492. Down here, we're at 2800. So cumulative delta is almost doubled in the negative sense. Here we got markets moving vertically, up, down, back up. Notice the deltas getting stronger. You're noticing the points of controls getting higher. You're noticing the buying imbalances. Now you're seeing some bearish points of control. You're seeing negative deltas come in. You're seeing lower points of control. Now you see the opposite going on. You're seeing higher points of control. You're seeing the buying imbalances. You're seeing the positive deltas here. Here's a nice vertical move, goes up, goes sideways, goes back up. All right. You're seeing the same things happening here. Higher points of controls. You're seeing positive deltas. You're seeing cumulative delta getting stronger in the sense that it's gone from minus 3,000 to minus 2,400. You get this little sideways activity here. This is your horizontal move. Then you get your vertical move back up here, right? Positive deltas. And you're noticing cumulative delta has gone from minus 2,300 to minus 1,900. So higher points of controls. So vertical, horizontal, vertical. Now, when a market is trading horizontally, right, we think of consolidation, rotation, but more importantly, market efficiency. When a market is trading horizontally and you're wrong, the damage is limited. Now, when a market is trading vertically, markets are a little bit more volatile. They're going to move quicker to profit targets. And in a vertical moving market, you want to get in as early as possible. So which is better for trading, right? Well, actually, it's two different market environments completely. If you want to decide which one has more profit potential, it's going to be vertical market. So ideally, all right, you want, like I said, you want to get in on a vertical move as quickly as possible. So what are you going to be looking for? You're going to be looking at delta. You're going to be looking at changes in cumulative delta. You're going to be looking for imbalances. You're going to be looking for points of control moving higher, right? So here, this market is a selling off. All right, we get down into the low, and you see how it just changes and shoots straight back up. What are the signs in the order flow? Well, you see the positive delta went from minus 900 on the low to 446. This bar's got 1-2 buying imbalances. You've got a higher point of control than the previous bar. We're still at negative delta, right? But we've gone from, on this bar here at the low, minus 1100. Now we're only at minus 690. Okay, next bar, again, higher point of control than the previous bar. You're seeing a couple buying imbalances, the 152, the 140. You're seeing a nice positive delta, right? Now cumulative delta, minus 450. So the signs are there of a potential vertical move beginning, right? In the next bar, 58 for the delta. Yeah, would I like it to be higher? Yeah, of course, but it's still positive. We've got a higher point of control. We've got a buying imbalance in there. Cumulative delta still negative, but it's gone from minus 1100 to minus 392. So that's a big change already. So you already have a sign that this market is starting to put in a vertical move. You know, you can safely get in, you know, anywhere in this next bar or the bar afterwards, you know, and where are you going to be placing your stop? You know, you have these points of control as levels that if the market retraces back down to there, you know, you're probably going to want to be thinking of getting out, but you already have a nice move up underway. So you notice you had the nice strong move down. It sort of stopped down here. Now you're seeing moving higher, points of controls moving higher. You're seeing the aggressive buying coming in. The vertical move is beginning, and you know, from here, this is 31.97 all the way up to these new highs, 32.07. It's a nice 10 points there. And the signs were in here in the order flow with the imbalances, the points of control, the positive delta, the cumulative delta getting lesser and lesser. And if you want to take it a step further, look at the max and min delta, right? You're seeing min delta after we, you know, on our way down, you see min delta very strong. Min delta 1100, 869, 956, minus only 55, 3, negative 3, negative 131. Where's your sellers, right? Where's your minus 800? Where's your minus 900? Where's your minus 500? It's just not there. So the selling isn't there anymore that you saw on this move down. Instead, you're seeing the strong buying coming in. So what are you expecting? When you see strong buying coming in, do you expect this market to stop and fall over? No, you expect the market to continue in that direction, which it does. Now, I've talked about this in the past, right? Recognizing a trend day. And on vertical moves, you have trend days, okay? And one of the signs that I always look for, and whenever I see it, I realize this day could be a trending day, is when I have several failed divergences in a relatively short group of time. Okay, so from 9:15, you got a failed divergence. About 9:23, I got another failed divergence. 9:25, another failed divergence, because I know that we took out higher. So to me, this is a sign of a vertical move, right? Any sort of sign of a trend day that you can have is a sign that there's going to be a vertical move, right? Because vertical moves are trend days. So I could see within 30 minutes, 15 minutes actually, I had 3 bearish things here that failed, right? So that's a sign of a vertical move. You know, when you have all these signals telling you to sell, 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 but the market keeps going higher, you got to buy it, all right? It's just sort of like what's going on right now with the stock market, right? I mean, we're in the middle of this coronavirus, you know, wave 2 coming on. You know, remember wave 1, how the market sold off, you know, like what, 30%. Now we're up near our highs again, and oh, it's so negative, you know, states are going to have to start locking down again, but the market keeps going up. What are you going to do? You sort of got to close your eyes and buy it, because everybody that's been shorting it has been getting their butt handed back to them, right? I mean, if you're not going to close your eyes and buy it, then you sort of have to sit on the sidelines and watch the move happen. But when you're seeing a lot of negativity in the market, and the market is just sort of shrugging it off, there's bigger forces at work. And your analysis, no matter how good it is, doesn't matter, because the forces that are at work are much stronger than your analysis, right? And they got the deeper pockets that are causing that move to happen. So horizontal markets are safe, but profits are limited, right? Because horizontal markets are generally markets in consolidation, and they don't have much price movement. Vertical markets are a little bit more riskier. Why? But profits are higher, right? They're riskier because you're going to have bigger movements. Now, horizontal markets are, what people refer to as efficient markets, right? Price is being accepted. But again, horizontal markets are not static, right? There are different conditions of horizontal markets. Vertical markets come out of horizontal markets, right? Vertical moves happen out of periods of efficiency, periods of horizontal moves. The market could be in a tight trading range. The market could be top heavy. The market could be tired. The market could be catching its breath. All of these terms are what people use to describe horizontal markets. Markets going nowhere. That's a horizontal market. So what you are looking for in the order flow is an inefficient area that the market is going to resolve. And often you have to pay a premium in price to take advantage of the inefficiency in terms of trade location, right? If a market is just trading sideways, you could work bids and work offers, and more often than not, you're going to get filled. In a vertical moving market, if you try to buy it by working a bid, forget it. Market's moving already. You're not going to get filled. We've all tried to buy, work limits in a market moving higher, trending higher, but you don't get it, right? You miss the trade. That's why I talk about you got to pay a premium, because you got to just lift the offer. You got to buy it at the market. The reason inefficiency occurs is because market conditions keep changing. So it's imperative to know that inefficiencies have a lifespan and are not static. And it's during the lifespan of the inefficiency that a trader who can identify the inefficiency has a chance to capitalize in it before it subsides and the market resumes towards normal conditions, right? Anytime there's a market inefficiency, it doesn't last very long, right? It could last 2 seconds. It could last 15 minutes, right? It could last sometimes a bit longer. But you have to be able to recognize it so you can capitalize on it, right? And that's your goal as a trader, is capitalizing on these inefficiencies. So market efficiency is determined when examining horizontal or vertical activity, right? Markets are not efficient very long, but when they are, that's when you're going to find the best opportunities. So when a market is trading at full efficiency, right, there's solid volume and trade is evenly matched, you got small deltas, price is not really moving. Wyckoff called this absorption, right? Vertical moves occur when markets move out of efficiency areas, right? And we all know that, right? You all see markets are rotating, and then boom, market shoots off 20 points in a direction. That's the rotation, that's the efficiency. The 20-point move is the market inefficiency. So you want to be able to get involved in that inefficiency as early as possible. So what are you going to look for in an efficient market? Well, generally you're going to have bars with solid volume and small deltas, right? I mean, that's sort of the way people decide that absorption is occurring in the markets. But you got to watch the other aspects of order flow, right? I mean, it's one thing to see small deltas and the market going sideways, but when the market starts to move, you got to understand what you're looking at to see the direction of the movement. Okay, so you can see right here in the middle, you got these couple bars in here, right? You got this area. You sort of just draw this box around here, right? I don't know if I could even do that right here. Let me try it. Okay, there's sort of this area in here, right? All right, you got this area in here, right? It's sort of going back and forth. I mean, you can even draw it out over here. You can see some small deltas, 26, 19, 1. Okay, but what are you noticing? Points of control starting to move up in a direction as you're going out of this area. You're seeing, any imbalances? You got 1, but as you're out of the area, you got this bar with 1, 2, 3 imbalances. Points of controls are going higher. Deltas are positive, right? So this is your efficient market in here. Actually, you could sort of draw this a little bit bigger. You could sort of draw it back there. And we finally broke out, right? You got the aggressive buying, you got the positive deltas, the higher points of controls. You're putting in your vertical move after your horizontal move. So remember, right? If you ever if you ever delved into market profile, right, you understand that markets go to where they can trade efficiently, right? So they're going to put in that vertical move to find a new value area, right? That's where they're going to trade efficiently, in the value area. So how a market makes a vertical move is important to note. Was the amount of volume trading heavy, or did the market slice through levels on light volume? So you got to understand, right? Markets move on heavy volume, markets move on light volume. Now there's different trading hours, I mean, I hate to say sessions, but you have like the Asian session, you have the European session, and you got the US session, right? So, okay, let's talk about E-minis. So obviously the Asian session is lighter volume than the European session, which is lighter than the US session. But when you're in the US session and you're making moves on light volume, then it can often stop and reverse pretty quick, right? And that's not necessarily a market efficiency. It just that's just a condition of the market. However, liquidity stops vertical moves, more precisely resting liquidity. So for example, this is the wheat market, right? You shoot up, right? You got some nice heavy volume coming in here, right? So it's not a move on light volume. So it's a strong move, but it's stopped by the liquidity in the market, right? You can see this point of control right on the extreme here, point of control right up near the top. Here's another bearish point of control. That's what stops a vertical move, is resting liquidity. It's sort of found an area where the market can trade efficiently before moving sideways or in the opposite direction, right? This was this bar right here in the wheat, right there. And then you just sort of come off, trade a little sideways, come off some more. So this move up was stopped by the resting liquidity. It got up to this area, started trading sideways, started putting in a horizontal move. But there's just too much volume up there, in the sense that supply was present in the market. And once people recognize there's supply up at these levels, they started to move the market away back where it's going to look for another area where the market can trade efficiently again. Here's a great example, right? Big move down, right? 3209 down to 3190. It's almost, this is a 20-point move. What stops it? The resting liquidity. You can see these points of controls right on the bottom down here, right? And this one, the market's just snapped right back up. So if you have a vertical move and you see resting liquidity, chances are the market's going to stop, right? Vertical move up stops at liquidity. Little move down, I wouldn't call this a vertical move down, but then you make that higher high and the move up, it's stopping this vertical move, and the market retraces all the way back down. Here, market is blends, right? Just pounding lower, pound. Where does it stop? It stops where you got the resting liquidity, right, in the point of control. Some people say, hey, can I use Bookmap for this? Yeah, you can. Honestly, I don't think you need it. As long as you understand points of control and where they're going to be acting as stopping volume or resistant volume, support or resistance, or you have Oracle's Trader software which will highlight those areas to you. You'll see it right there, right? You don't need all these different Bookmap things showing up on there. NinjaTrader has one for NinjaTrader 8 paid version, so if you have that, you can throw it on your screen. Sierra Charts also has one. And a lot of the other softwares out there are now implementing it as well. But look at areas where liquidity exists in the market, and that's what's going to stop a horizontal move, a vertical move. And oftentimes the market is going to go horizontal at an area that you got liquidity. So remember, just because you hit a spot of resting liquidity, that does not mean the market can't revisit it and take it out. Okay, just a lot of times people, I talk to traders that have buy like all the different softwares, and they move around from one to the other. My software, then they get Bookmap, then they get Jigsaw, and they're like, well, when I talk to them, they say, well, yeah, I had Jigsaw and I didn't find it useful, and then I had Bookmap and I didn't find it useful. I had this other software, I didn't find it useful. Well, because they're sort of looking for, in a sense, a holy grail as opposed to not understanding the market, right? Just because you have resting liquidity, right? What they'll do is they'll say, well, yeah, on the Bookmap it had, well, I'll get to the next chart. Right, a Bookmap had resting liquidity up here, and it came off, then it came out and took it up again. Right, I got short right at the resting liquidity, just as people that trade the dome will see, oh, there was a big offer there, I got to get short. Then the market turned around and rallied up, and they got their head handed to them. Resting liquidity is fleeting. Okay, it's not permanent in the market in the sense that it's got to stop right there, and the market's got to reverse and sell off to new lows or rally to new highs. It can hit that resting liquidity, come off, build up some more steam, get through it, find another area of resting liquidity. That's just how the market works, right? So be aware of that. When the market tests an area of resting liquidity, if it gets through it and continues its move, it can go higher, right? Perfect example, resting liquidity here. Up at the high of the day, the move up, vertical move up, stopped, and you got a vertical move down. Okay. It stopped at resting liquidity, came back up. Doesn't mean that it's got to stop right at this earlier resting liquidity here. Came back down, found a new area of resting liquidity, went back up before going back down where you have a new resting liquidity here. So, resting liquidity is dynamic, it changes, but keep an eye on it and understand where it is and how the market's going to trade around it, because at the end of the day, that's what's going to stop a vertical move. That's the best way to stop a vertical move. So vertical moves, market inefficiencies end or become complete when horizontal moves begin, right? So you have a vertical move in a direction, you move higher, new highs, then you stop, you go sideways, right? You just rotate around the high. That's your horizontal move. Market's found a place of market efficiency. Then the market's either going to go higher, look for a new area, or go lower and find an area that it was at earlier to trade around. Most of the time, markets are efficient, right? When markets are operating efficiently, trading is orderly and random, right? I know people don't want to say trading is random. Trading in the next tick is random. You don't know if it's going to be up or down. Order flow can be read to determine the direction of the market, but in the sense that the next order that's going to hit the market, that's completely random. You don't know if it's going to be a buy or sell. You would hope it's going to be more buys if you're long or more sells if you're short, but let's be honest here, right? When a market is efficient, there's buy and sell orders in both. You got buys and you got sells. You got orders in both directions coming into the market. That's a sign of an efficient market. They just happen to balance each other's out. Now, when the markets are not being efficient, that's when trading becomes disorderly and non-random. Okay, and what I mean by non-random is you have a preponderance of orders in one direction, buy orders on a market that's going up, sell orders on a market that's going down. When something is non-random, that means you can make determination of what happens next because it's no longer random, right? If like card counting, right? In the old days, in the 60s, when it first became popular, right? You had the single deck, and as you remove cards, sort of the randomness disappears because, if you remove a bunch of face cards, that what's left over is going to be low number cards. So you've sort of removed that randomness of the next card coming up is going to be a face card because you took out most of them, and what you have mostly left are the smaller cards. Now, you can't talk about vertical or horizontal activity without understanding bar strength, right? Without understanding underlying bar strength, there would be no vertical movement. So how can you determine the bar strength? Well, strength in up bars, okay, is bars that close near the highs. That's obvious, right? Anybody knows that. If a bar closes on its high, it's been a strong bar. But watch where the max delta closes, right? Are we closing near the max delta in terms of the delta? And weakness, up bars close mid bar or lower, right? It could still be a green candle, but the bar is going to close not near as high. It's going to close somewhere in the middle, or maybe you have a small little up, small little green area. Max delta can be kind of mixed. Just because you have a max delta, your delta is going to be positive, but what I'm saying is your max delta can be, it could give some back, right? Your max delta could be 400, but your final delta is 200. Okay, that's kind of, not necessarily a sign of weakness, but that's just your average bar. Now, strength in down bars, bars that close near the lows, bars that close the final delta near the min delta. And weak down bars are bars that close somewhere, mid bar or a little higher. Okay, so we know markets move on supply and demand, right? When an up bar closes near its high or a down bar closes near its low, supply and demand is one direction, and you expect the market to move in that direction. But if an up bar trades to its high, then selling comes in, supply comes in, and a bar closes near its midpoint. What do you think is happening? Okay, so think about that, right? You had an up bar, trades to its high, and then selling comes in. What is selling? It's supply. The bar closes near its midpoint. What do you think is happening is supply is coming into the market. Sellers are coming into the market. So that's not necessarily a good sign of strength. All right, so strength, one way to determine it is looking at the max deltas and the min deltas. So for example, we're going into the highs here, right? Max delta, 817. Final delta, 817. Close up here on our high. Next bar, retraces back, closes higher. Okay, but you got that big wick there. Got a negative delta. That's not a good sign. Next bar, you hit the high, then you come off, right? So this is a weak high going in there. It came off a bit. Again, you coming up into this high. You got the max delta, 797 on this green bar. Final delta, 721. Next bar, 222 max delta, but you got negative delta, minus 204. Next bar, obviously, this red candle. Max delta was 460. We closed at 367. This is a weak bar right here. So you got a weak bar on a high, just as you had a weak bar on the high earlier. What happens? The market sells off. So as you're going up here, you could sense that this market is, this move up is getting weak. Right? You noticed it a little bit earlier here where you pulled back. Here you pulled back. Right, this pullback didn't continue on down. It got a little bit more strength and put in that new high before it pulled back down to these lower levels that you were at before. Now here, this is interesting because what you have is a case of the weakness weakening. Right, so on this move down, you got big strong min deltas. Minus, just starting here, minus 614, minus 1592, minus 749, then minus 886. As you're at your low, minus 198. Okay. More importantly, you see the max deltas getting stronger. Here was 230. Here was 16, 120, 371, 1000. Right. So you see max deltas growing, min deltas getting smaller, max deltas getting bigger. What do you think is going to happen? Well, what is happening? Buyers are coming into the market, moving the market higher. A quick 10 to 15 points there. Now, one way to think of it is market dominance, right? And max and min delta are going to be one-sided on a market that's dominant, and market dominance occurs in vertical moves. So, for example, here's this nice vertical move up, making new highs. So let's take a look at max and min delta relative to the final delta. Just starting here, max delta 1234, final delta 1203, min delta minus 181, right? Then minus delta minus 1, minus 57, minus 21. You got one big bar here, minus 602. Okay, no reason to panic yet. Then minus 46, minus 37, minus 51, minus 58. Where's your selling in here? It's just not present, right? Except for this one bar. There's really no strong selling. And if you're looking at the max deltas in relation to the final deltas, we're closing right around those numbers. 558 versus 499, 631 versus 619, 459 versus 428, 578 versus 574, 808 versus 708, 558 versus 494. So this market is dominant to the buyer side. Now, I talked earlier about resting liquidity shutting off vertical moves, right? But you could also look at the max delta and the min delta. I sort of hinted at that a couple of charts ago, but watch what's going on here on this move down, right? Very little max deltas here, right? You're seeing 0, 0, 75, 8, 0. All of a sudden 262, 169, right? So you see the buying is coming in, even though these are bars that are very small ranges, just sort of looking like it's going nowhere. You know, granted, this is on E-minis at just before 1 a.m., but you can see the volume, right? You can see the delta, the aggressive buying in here, right? And you see, where's your aggressive selling, right? You know, on this move down, it's minus 135, minus 182, minus 350, minus 7, minus 17, and it's all mostly max delta. That's what's stopping this move down. It's hidden in the max and min delta that this market is probably not going any lower. Imagine you're just buying it here at 15. Yeah, you're stopped down here, 13, 13 and a half. It's a quick move up to 18 over the next 2 bars. So again, you know, very simple, right? Max and min delta shutting it off, right? It's a nice strong negative deltas, minus 300, minus 400, minus 100, then minus 25, minus 56, 0. Hit that last push, 137, 57, negative 78. But then 5, 18, 4. You know, honestly, I would have been looking to buy in here around this 52 area. Yeah, I'd have my stop down here. I probably would have been stopped out. But then you still got to get long, because what I'm seeing in here, we're at a new low, and now I see the buying coming in. You know, you could add more to it. You can see the aggressive buying with imbalance here. This bar got 2 imbalances, buying imbalance, buying imbalance, buying imbalance, buying imbalance, buying imbalance. Obviously the positive deltas, but the exact same reason for wanting to buy here is showing up in here. So yeah, you take a small loss here, but you still got to get on the horse and ride it, right, to get out of town. So you're getting stopped out here for 5 ticks, 6 ticks, but the same reasons for getting long here. The small min deltas here right around the lows tell me that this selling is no longer present. Yeah, I tried to buy it here. There's just one last push of selling came in here, stopped me out, but now I think the market's run out of selling and it's just mostly buying coming in here. You know, get long at 50 all the way up into the 60s really quickly. Make back what you just lost very fast. So in vertical moves, you often see what you don't expect in terms of price action in relation to delta, right? Normally you expect to see up bars with positive delta, but often you see up bars with negative delta. Conversely, you expect to see down red candles with negative delta, but often you see down red candles with positive delta. This is a form of resting liquidity, right? Support the market on the way up or offering resistance on the way down. You know, resting liquidity is support on the way up, or resting liquidity is resistance on the way down. So for example, you got a market moving up. Well, you got a market moving up on negative delta. Here's a negative delta bar here, negative delta bar here. What's happening is there's strong bids in the market. You see the 192 down here. That's what's causing this 52. Most of the volume is right on the bottom of the bar. Over here, you can see the 279 to 218, right? This is supporting the market on the move up. So you often see resting liquidity trailing in this sense, resting liquidity not in the sense of offering resistance up there, but supportive buying. That's a form of liquidity. Resting liquidity is people bidding the market on the way up, and you're going to see that. You're going to see the green bars with negative delta, or red bars with positive delta. So again, similar thing, market's trending higher, right? You're seeing green bar, negative delta, green bar, negative delta. Whoops. Green bar, negative delta, right? Green bar, positive delta. But what are you seeing? You're seeing the selling balance, 1147, right? You're seeing the big size here, 729, right? You can just see it. All the bids here are very strong relative to what's traded on the offer. Right, you see that in markets going higher. Now, in markets going lower, right, you're going to see positive delta in red candles, like this bar right here, right, 1464. Right? This is setup that I'll be talking about later, right? It's called layering in. On the moves down, you're seeing people coming in, offering out liquidity, working offers here, right? You're seeing 659 positive delta, 486 positive delta. You're seeing 98 positive delta, right? As the market is trending down. Every time the market comes down, it bounces up, there's somebody there to offer it out. Market hits a new low, comes back up. Someone's there offering more liquidity, offering more supply, helping to move the market back down, down, down. Now remember, vertical moves offer great profit potential compared to markets that are trading horizontally, right? Why? It's because markets that trade horizontally just, tend to trade in a tighter range. Vertical moves have wider ranges. You don't know exactly where they're going to stop. But by now you should be able to identify vertical movements when they are underway, or more importantly, when they are ending, right? Because remember, after a vertical move, you often have a horizontal move. You don't necessarily get vertical move followed by vertical move in the opposite direction. And lots of times it's vertical move, then horizontal move. This concludes Module 4. In Module 5, I'm going to discuss fresh money in the order flow and how to recognize it. So I'll see you there. Bye-bye.